Okay, let's get started. So, first of all, I want to say good morning and welcome to the BGL Online Summit, a virtual event showcasing some of our RegTech 2025 sponsors. My name's Lily Williams. I'm the Partnerships Manager at BGL, and today's session, Getting ECPI Right, is co hosted by Acurium. So I'm pleased to introduce today's presenter. We've got Matthew Richardson with us on the call today. Matthew is the SMSF manager at Acurium and with over 12 years of experience in the SMSF industry. He's passionate about providing practical education to help professionals navigate complex topics, and we're excited to have him here today to share his expertise. Before we do get started, I will just cover some general housekeeping. Firstly, the session today will be recorded. So if you need to leave early or you came late or you missed anything, you will receive a copy of the recording post-webinar. And we also post the webinar on our YouTube channel, so you can refer to this afterwards. We will have the Q&A function available. So if you have any questions throughout the session for Matthew, please pop them there and we will run a Q&A session at the end. And Matthew, I'll hand it over to you to kick things off.
Great. Thank you, Lily. And good morning to everyone joining us today. So yes, as Lily has said, today we will be going through ECPI. We'll cover a few different topics, sort of the general, the main bases we need to cover when discussing ECPI, how we're going to do that, whether claiming under the proportionate or the segregated method, disregarded small fund assets and ECPI. And if we have time at the end, we will look at failing the minimum pension requirements. And as we go through, we'll discuss some of the main questions and issues that we receive as an actuarial certificate provider around those areas, and discuss some options for funds who are looking to try to maximize their exempt income as during an income year. I will say a lot of what I'm going to say is based on, as I said, questions that Acurium receives as a certificate provider. My answers should be correct for anyone, no matter which actuarial certificate provider you do use. My understanding, at least, is that for the most part, we cover all these scenarios the same way. But I do apologize if anything I say is not absolutely correct for anyone who does use a different certificate provider. But jumping right on into it. So on to the proportionate method. So as we said, there are two different methods for a fund to claim exempt income during the year. And well, taking a step back, a fund will only claim exempt income when it has pension, a retirement phase income stream in the fund during the year. And this first method of claiming exempt income is the proportionate method, which is where a fund has that retirement phase pension account, but also has some accumulation money during that income year. So under the proportionate method, you will have to go to an actuarial certificate provider like Acurium or like any of the several other certificate providers in the market, and you will obtain an actuarial certificate from them. That certificate will give you an exempt income proportion, which you can then apply to the fund's unsegregated assessable income. And with that number, you've now worked out your exempt income for that year, and the fund would then pay tax on the remaining income. Now, you can see a few notes there. There are some things to note and to remember when it comes to claiming exempt income under the proportionate method. And the first one I've got there is that claiming under the proportionate method is a choice. You require an actuarial certificate if the fund is going to be claiming that exempt income under the proportionate method. But you don't have to. You may have the situation where, for whatever reason, it's just not worth it for the fund to claim that exempt income for the year. We see maybe for whatever reason the fund had, it was mostly a bank account and it was only in interest during the year. The fund's overall made a loss. It has a large tax loss carried forward from the prior year. There are certain situations where the cost of getting that actuarial certificate and the effort you're going to claim exempt income under that proportionate method isn't actually going to be best for the fund. The cost of that is going to outweigh the benefit. So in that situation, the choice can be made to just not get the actuarial certificate and to say, for this year, the fund is not claiming exempt income under the proportionate method. We don't get that actuarial certificate, and the fund is effectively treated like it's fully taxable for that year. That is always an option, though, of course, as an actuary, not the one we want to see you doing, but if that works for the fund, that is totally up to you. Second point there is that the certificate must be for the entire year, unless that fund is winding up. Again, something we saw a lot coming up to the end of the prior year, coming up to 30 June, see funds trying to get in early to get an idea and submit their applications. And sometimes we also see that for, let's say during the year, someone's looking to start a new pension account, or someone is looking to pay out a member balance. And we will have applications submitted to us. And in those situations, it's not possible for us to complete a finalized certificate for the year because essentially the year hasn't ended. There is still more of the year where that fund will have balances, it will have pension accumulation, and that actuarial certificate needs to cover those future periods. So the certificate must be for the full year, and we can only do it after the year's ended. And the only time that that's not the case is if the fund has wound up during that year. Now, saying that, we can still help if you are, as I said, looking to get a percentage partway through the year to help with paying out a member balance or starting a new pension account. We can do a draft for you covering that certain period of time. And if that's what you're looking for, just make sure you let us know when doing the application. And as I said, my understanding is it works essentially the same way for the other actuaries as well. And that last point there about periods which are solely in accumulation phase being unsegregated. This does come up a reasonable amount of every once in a while, and I think it is in relation to funds which are solely retirement phase pension for a certain period being segregated, which we will cover soon. The understanding that if a fund is solely accumulation for some of the year, but then for the rest of the year is that mix of pension and accumulation, then the calculation from your actuary should exclude that period of accumulation. That's not the case. That period of accumulation is included. It is not segregated by default. It's not deemed to be segregated like periods which are solely pension. So the actuarial certificate would again cover everything, including those periods which are solely in accumulation phase. So just make sure to be aware of that. We have had people before not understand that, and they've made plans and sold assets based on an incorrect understanding of how that would work in the situation. Now, looking at this proportionate method though, and as we said, we're going to look at essentially what a fund can do to try to improve the situation. And under the proportionate method, essentially with how the calculations work, once the financial year is ended, there's not really a lot you can do to improve that calculation to try to improve your exempt income. Because with how that calculation works, we see here, under the proportionate method for claiming exempt income, your actuary will do a calculation of the average retirement phase liabilities divided by the average superannuation liabilities in that year to work out the exemption. And that's based on both the dates and amounts of the transactions that happened during the year. And of course, once the year is ended, we can't, or at least shouldn't be going back and making any changes to those. So once the year has finished, this calculation is for the most part set in stone. So when it comes to trying to maximize your exempt income under the proportionate method, this is more of a forward-looking sort of strategy to think about what's going to be happening later on in this year or in the next year, and what can be done to try to improve that exemption. And as we see here, because it is, as I said, based on both the dates and amounts of the particular transactions during the year, that is how you can try to improve that exemption. So if we want either to increase that average pension, your average retirement phase balance, so we want more in retirement phase on average, which would mean making pension payments in lump sums later in the year, or starting a pension earlier in the year. Or alternatively, we want to try to have less in accumulation, less in non-retirement phase. So we can make accumulation withdrawals earlier in the year or contributions later in the year. But again, as I said, that's all forward-looking. We can't go back and change those things. So it would have to be something that at the start of the year, when we're thinking about what's going to be happening, we just have these things in the back of our mind. And with everything I say today, talking about ECPI, this is purely based on ECPI and trying to maximize that. Of course, there are a number of other factors you would want to consider for any fund when making any of these sort of decisions, and that should all be looked at before anything is done. It shouldn't just be done purely on an ECPI point of view. But now looking at this, we have a basic example here. If we look at this fund, we say, okay, 1.8 million member balance, 1.2 million pension, and 600,000 accumulation at the start of the year. 15th of August, 90,000 pension payment to meet the required pension standards there. 12th of October, 120,000 non-concessional contribution. And then on the 1st of June, near the end of the year, the member withdraws 250,000 from accumulation. And then we see those closing fund balances. And we see a graph here of what that would essentially look like for the fund. And the resulting exemption based on those details is that this fund is 62.747% exempt for this year. And that's not bad, certainly. You think, it's almost 2/3 exempt. So that would be great. But with those same details, what would that look like if we did try to adjust those withdrawals, those transactions to try to maximize that exemption? So even assuming we're using the same transaction dates, but we just move them around, if instead we now had the withdrawal from accumulation happening on the 15th of August, and we move our contribution and our pension payment later in the year, happening on the 1st of June. If we make that change, the exemption goes up to 75.324%. So that's more than 10% increase. We haven't changed the numbers at all. We've just moved when they happened. And if we wanted to, we could even try to maximize that even more, have the withdrawal even earlier in the year, the contribution and the pension payment later in the year. Though, of course, you want to be careful there to make sure that you don't try to move it too late. And then if an accident happens and you make no payments, that would, of course, be worse than not maximizing as much as possible. So that would, of course, be the first goal, is to make sure that the minimum pension standards are met. But we could see there we could maximize that exemption even more. And then with some very basic numbers, of course, excluding many other things that would come into this calculation, we see here with a fund with 120,000 assessable income, comes out to a difference of over $2,000 in how much tax that fund is going to pay. And that's just moving around the timing of some of those transactions. So again, thinking forward for the year ahead, if the fund knows that the trustees are aware that there's going to be certain large withdrawals, they might want to make that, think about the timing of those sort of things. Of course, a lot of the time there's nothing you can do. Things might come up unexpectedly, or people will just change their mind. And if that happens, that is what it is. But it is always something to think about looking forward to the next year, or looking forward to the rest of the current financial year, and saying, what do we think is going to be happening? What would be the best way to organize this, to time these transactions, to try to maximize that exemption for the fund? Now, that was claiming our exempt income under the proportionate method, going to your actuary and getting an actuarial certificate. But of course, we do have our other method of claiming exempt income, which is the segregated method. So in this case, we have assets segregated to support a pension account, a pension liability. With that being the case, you don't require an actuarial certificate. Under section 295.385, that income is just fully exempt, no actuarial certificate required. And there are a couple of ways we can claim our segregated exempt income, either through elected segregation, which has been around for a long time, or we have deemed segregation, which is newer, with the ATO sort of clarifying their view from 1 July 2017. But both of those scenarios is the same. Any segregated income is fully exempt. Capital events are disregarded essentially in that period. And again, we have a couple of notes there on the side. Of course, yes, segregation is a powerful strategy for a fund. And as we said, segregate an asset, have that gain as fully exempt. But first off, it should be out of order here, but it should be consistent with that fund investment strategy. It's not purely a vehicle to reduce tax for the fund. It is consistent with the trustees and their long-term goals in retirement. And part of that, it should be established in advance. Again, like we talked about claiming exempt income under the proportionate method, once the year is ended, you can't really go back and make changes to that to try to improve it. So it is more of a forward-looking thing. The same with segregation as well. You can't really get to the end of the year and then go back and say, oh, actually, with what's happened during the year, we now want to say that asset was segregated from the start of the year. You can't do that. You do need to establish that segregation in advance and make sure there is at least minutes, something to show that was considered in advance of when that segregation is going to be starting. And a note there, just to be careful to meet all the pension requirements. Like we mentioned before, but I've had scenarios with people where their intention is to fully commence a pension, sell assets, then stop the pension, essentially. And then the question is, yes, even if they make one pension payment, a pension does require a series of payments. Sort of the basic requirements need that. And starting a pension, making one pension payment, stopping the pension, technically you haven't satisfied that requirement. Would someone come to you about that with an issue? I couldn't say, but technically that would be a problem. And you want to make sure you're not so focused on trying to segregate the asset and maximize a gain in a segregated period that you're not excluding these other requirements. Again, we see here just a bit of an example of a fund which has segregation, in this case, both elected segregation, where the choice has been made by the trustees, and deemed segregation during the year, which fund can have both. And now to talk a bit more about elected segregation, but we'll go through this reasonably quickly. As we said, elected segregation is a choice specifically made by the trustees to say, yes, we want these assets, this asset, to solely support retirement phase pension. On that solely support retirement phase pension, we now know this asset is segregated. Any income on that will be fully exempt. Again, some things to be careful of. We've talked about it being set up in advance, and while there's no specific documentation needed, or like no specific form that you have to fill out, you do need to make sure it is documented. Part of the investment strategy, as we said, fund minutes to establish that, showing the detail, showing the particular assets being segregated, their value, what date this is happening, all those sort of things. And one thing to note there as well, which does come up every once in a while for segregation, is that you can't segregate part of an asset. So if you are going to segregate an asset to support retirement phase pension, it has to be the full value of that asset. That could come up a lot more for something like a property, where it'd have to be the full property that's segregated to the pension. You couldn't say, well, 50% of this property is segregated to support the pension, and 50% of the property is just unsegregated, supporting other pension and accumulation money in the fund. That wouldn't work from a tax point of view. One exception to that is a bank account. A bank account can be essentially partially segregated. So you can segregate part of a bank account and have another part be unsegregated. But as I say there, it may not be advised. Just to make things clear, it may be easier to have a separate bank account for any segregated assets and another bank account for unsegregated assets of the fund. And I guess on that definition as well of a single asset, shares, like a single share is an asset, even if it is bought as a parcel. So you could have you buy 10,000 shares of BHP at one time. You could segregate 1,000 of those shares and have the other 9,000 as unsegregated. You would want to be a bit careful there, though, that you have a specific share number. I've seen it before where people have said a percentage of the shares, but that percentage, when you look at the number of shares, it actually came out to 1,520 shares 0.44, which means that you're now trying to segregate part of a share, and that act doesn't work, as we've said. So if you are going to do that, make sure to say a number and not a percentage. And here, just again, an example of a fund has an asset segregated to support a pension account in that fund. It's around 20% of the fund balance. And then the remaining fund is unsegregated pension and non-retirement phase accumulation. And how that exemption would work, as we've said, the segregated part of the fund is 100% tax exempt on any of that income. And then your actuary would prepare an actuarial certificate under the proportionate method, because you can use both methods during the same year. And under the proportionate method, the rest of the fund is, in this case, 42.587% exempt. Now, that was elected segregation, has been around for a very long time. We do now, as I've said, also have deemed segregation, which was technically meant to also be around for a long time, but the ATO did clarify their position from 1 July 2017 onwards to essentially now establish this deemed segregation, or that funds have to treat the situation in this way, where for any period of the year where the fund is solely retirement phase, it is deemed to be segregated. We know for that particular period of time that all the fund assets are solely supporting a retirement phase pension. So therefore, for that particular period where the fund is solely retirement phase pension, it is deemed to be segregated. And as I said, that wasn't a choice made by the trustees. It was just a question of fact based on what the current situation of the fund at that particular point in time. Because of that, it does mean the fund could have multiple periods of segregation during the year, where it goes from being fully retirement phase pension to now having some accumulation balance, and that could happen a number of times, and frankly did make that a bit complicated. And I believe part of that we did see this essentially updated, or at least an additional option given for the 2022 financial year onward, where the ATO said, actually, yes, we understand that this wasn't how it essentially was always done. So therefore, there is now a choice in this situation where a fund has a period of deemed segregation, where you don't have to claim ECPI using the segregated method, which we'll cover quickly in a second. Yeah, another example of what that might look like for a fund. We see this one here, starting the year with pension and accumulation money. Then part of the year, it's solely retirement phase pension, deemed to be segregated. Another period of pension and accumulation. And then again, another period where it is solely retirement phase pension and deemed to be segregated. And from an ECPI point of view, that would work with having those two periods, which are solely pension, deemed to be segregated as fully exempt. And then those two other periods where there's a mix of pension and accumulation as unsegregated. And again, you would go to your actuary who would do the calculation looking at just those unsegregated periods. And in this case, it's 70.377% exempt for those two periods where the fund is not segregated. And we've had this question come up before as well. Yes, it is the 1% calculated by your actuary, which does apply to those two periods. There's not a separate calculation done for each separate period. Your actuary looks at all of the unsegregated details of the fund for the full year, even if in this case they are separated by a period of deemed segregation, and works out that single percentage, which applies to all of the unsegregated income for the year. We talked about claiming under the two different methods, proportionate and segregated, and some ways that we can look at that to try to improve our exempt income. But there was another rule, another new rule from 1 July 2017, which essentially impacted on that ability to claim exempt income, and in some cases forced the fund to claim exempt income solely using the proportionate method, where it may have wanted to be segregated or may have had periods of deemed segregation. And that was this rule about disregarded small fund assets. And essentially this was a new annual test. So each year the fund does this test here. We can see what that requires. You do this test, and if the fund meets all those conditions to essentially have disregarded small fund assets, then it can't be segregated in that year. And again, have had people with this problem before where the intention was to have segregation. That's what they wanted. And they may have made plans. They sold assets with that understanding that they were segregated and would be fully exempt. But the fund had disregarded small fund assets for that year. So unfortunately, the fund couldn't claim any exempt income using the segregated method, even though that was their intention, what they wanted to do. Instead, they had to claim exempt income using the proportionate method, and that capital gain, which they were intending to have as fully segregated exempt income and just disregarded, now had to have the exempt income percentage applied to it under the proportionate method, and they ended up paying some amount of tax on that when they're expecting it to be fully exempt. So you do need to, for any funds which have segregation or want to use a segregation strategy, you need to make sure you are doing this test each year, just to make sure you understand that even if you want to be segregated for that year, well, maybe you can't be. And we see that test here. Essentially, you look at the fund, you look at all the members, and as at the prior 30 June, so if you're doing 2025 financial year at 30 June 2024, you check each member, did anyone have more than 1.6 million total superannuation balance? And a couple of notes there, it is 1.6 million. That number hasn't been indexed like the general transfer balance cap. So still 1.6 million as it was in the 2018 financial year. And if anyone does have more than 1.6 million, did they also have a pension, a retirement phase income stream? And to note, that doesn't have to be in the SMSF, just in any fund that they're a part of. Did they have more than 1.6 million overall and a retirement phase income stream? And then, of course, that person is a member of the SMSF, and the SMSF has someone who is solely in retirement phase for that year, or who has a retirement phase balance in that year. You meet those requirements, the fund has disregarded small fund assets, and you see that final point there as well about the fund not being solely retirement phase for the whole year. That was an update to this test that came in for the 2022 financial year to cover funds which were solely pensioned for the full year, but could still meet those requirements and have disregarded small fund assets. So there were funds which were fully exempt, just solely pensioned for the year, but which could not claim exempt income using the segregated method. So had to go to the actuary, get an actuarial percentage, which would be 100% exempt, and pay for that certificate when it really wasn't necessary. So that was just to cover that. Really quick example here, we'll go through. We'll try to get through go reasonably quickly now for time purposes. But we have our example here for DeLorean SMSF. We have Marty, who has a total super balance of 2.23 million, all accumulation, with 1.5 in the SMSF and 720,000 in an external fund. 3rd of December, Marty turns 65. He converts his full balance in the SMSF to pension. And then later on in the year, on the 19th of May, Marty rolls in his balance from the external fund into the SMSF. So based on that information, does the fund have disregarded small fund assets? We can see what we would look at on the right side to check if that's the case. And in this situation, the answer is no, the fund doesn't, because we can see, even though it does tick most of those requirements in that test to have disregarded small fund assets, the one thing that it didn't have, though, was a member in retirement phase at the prior 30 June. Yes, Marty had more than 1.6 million, but he was solely accumulation. So therefore, this fund would not have disregarded small fund assets, and therefore it could be segregated for this year, or it could claim exempt income using the segregated method. And this would be a scenario, again, nothing we can do after the year is ended, but at the time, this would be a situation where the fund may want to look at how it's claiming exempt income, because in this situation, we essentially have the fund, which is accumulation for a period, solely retirement phase pension, and then a mix of pension and accumulation. And if we look at the years going forward, assuming that accumulation money isn't paid out, in future years, the fund is going to have disregarded small fund assets, while it has more than 1.6 million, because Marty has a pension and an accumulation balance, and his total super balance, certainly at this point, is much more than 1.6 million. So for several years down the road, the fund may have disregarded small fund assets, and all its exempt income will be claimed using the proportionate method, which, based on the current information, would be around 2/3 exempt and 1/3 taxable. But you think, when Marty started that pension, if he had have thought about the future and gone, well, for the next several years, the fund may only be about 2/3% exempt, and we can't segregate, so all income will be, we'll have to pay tax on 1/3 of that income. Whereas if he had between the 3rd of December and the 19th of May, the fund was solely retirement phase pension, as we've discussed, it could be deemed to be segregated for that period, because the fund in this year doesn't have disregarded small fund assets. So it may have been a good idea to sell assets in that period. If it's sold between the 3rd of December and the 19th of May, it's being sold in a segregated period, a deemed segregated period, and could be fully exempt and not pay any tax on that. Whereas if it's sold next year, then that's paying, as we said, around 1/3 tax on any gain. So again, of course, other things to consider when selling an asset, but in this year, there was a chance to sell assets as fully exempt in this first year, because the fund doesn't yet have disregarded small fund assets. Whereas if it waits, sells any assets in future years, where they could be 1/3 taxable, or even more taxable, depending on what happens with the fund going forward. So this would have been that chance at the start of the year, or when the pension started, to think about the future, what's going to happen there, and go, is it worth it to sell assets now and have them as being fully exempt in this deemed segregated period? Circling back very quickly, so ECPI choice, as we discussed, with that deemed segregation, there was a change made in the 2020 year, which essentially said that for a fund which has a period of deemed segregation, where some of the year is solely retirement phase pension, but not the whole year, whereas with the clarification by the ATO, you would have had to have treated that period as solely retirement phase as segregated, and the rest of the year would be unsegregated. We were essentially given the choice back to say, actually, you know what? No, we don't want to be segregated at all during this year, and we'll go back to how we treated it before 1 July 2017, and just say the fund is unsegregated for the entire year. We just want to be proportionate, that we don't want to have any segregation. And that gives funds more flexibility on how they're going to claim their exempt income. And probably the only thing that we've discussed, which can be made after the year is ended. Making this choice, in this case, you can see the choice to either do nothing and use the default approach, which is to have periods of deemed segregation, or the choice to say, actually, we don't want to have any segregation. We want the full year to be proportionate. That can be made after the year is ended. So you can look back at the year, see what the result would be under both those methods, and then make the choice which would give the better outcome, and which, as I said, is one of the very few things that a fund can do after the year is ended to then change their tax outcome. The question then becomes, though, when do we want to make this choice? When is it worth it? When is it worth it to go to that extra effort of essentially working out the two different results and deciding on the best one? And for a fund where there hasn't really been any material capital gains or losses during the year, the income is all reasonably uniform across the financial year, the choice isn't really going to matter that much. your exempt income is still going to be very similar, whether you make the choice to be proportionate for the full year and just have that one tax exemption apply to everything, or to have the period of deemed segregation and a period which isn't deemed to be segregated, like we can see from the example shown. So yeah, no material gains or losses. The choice is going to be not really going to matter. It's going to be a very similar outcome either way. Now, the choice does start to matter though when we do have capital gains and capital losses, any sort of material income or loss amounts that is happening during the year. At this point, it now, whether they've happened when the fund was the mix of pension and accumulation, or when the fund was solely retirement phase pension, it will change that outcome, and we would have to consider the outcome under both methods to try to work out which would actually give the better result. So very quickly through this final example here that we're going to be looking at. So we have a fund, 2 members. Start of the year, the member was solely accumulation, 1.66 million, and the other member hadn't joined yet. 26th of October, again, pension commenced for the entire accumulation balance. And then on the 16th of March, the second member rolls their balance into the fund. So in that case, we can see here what that would look like for the fund: period solely accumulation, period solely pension, and then a period of pension and accumulation. And we can see here some very basic numbers for capital gains and capital losses during the year, and how just there is some regular assessable income as well being earned, dividends, interest, etc. Now, first off, looking at this situation and saying that we're not making the choice to be proportionate for the full year. So instead, that middle period where the fund is solely retirement phase pension will be deemed to be segregated, and our actuary will instead look at the rest of the year, the first period of solely accumulation and the third period where it's pension and accumulation, and they will do their calculation of exempt income, the ECPI percentage based on that. And in this scenario, we see the ECPI percentage is 36.397% exempt. And as we said, that would only apply to the first and the third periods shown here. And you actually should make that clear as well when they're providing that. You can see that picture on the screen there. What that would mean from an ECPI point of view, we can see the calculations on the right. We're assuming all the assets have been held for at least a year, so they're getting that discount. We see the calculations there with that ECPI percentage of 36.397%. And we get total exempt income for the year, 71.890. The capital gain happening in that middle period is disregarded. It's in a segregated period. And the ECPI, the regular income in that middle period is technically still shown as ECPI in our return, just segregated ECPI. So total ECPI of 71,890. But now we have the scenario where the choice is made to be proportionate for the full year. And now we just have a single exemption, 54.112%, which is going to apply for the full year. There's now no deemed segregated period. It's just one calculation for the full year, that one exemption. And now we see what that looks like here. The fund is now unsegregated for the entire year. And that single percentage of 54.112%. And now doing those calculations on the right, we get exempt income of 102,993. And if we compare the ECPI amounts, it does look like that second option gives us the better result, the better result for the fund with more exempt income. But if we look at those calculations in a little bit more detail, that's not actually the case, just because the capital gain being disregarded in that segregated period did sort of throw off our calculations a little bit. If we look at this though and look at the actual tax the fund would pay, of course, ignoring many other things which would impact on this calculation, we see that under the first approach, where we make no choice, the fund is going to have that period of deemed segregation in the middle. We do our calculation and our taxable income comes out to 78,000. But under our second option, where we do make the choice to be proportionate for the full year, our taxable income is actually 87,000. So in that case, it's 9,000 difference there on our taxable income. And in this scenario, we would not want to make the choice we would want that period of deemed segregation, and that would give the better outcome for our taxable income. But of course, that's very much this specific scenario. As we said, it's going to depend on the timing of the income and any losses about what gives us the better outcome here. And it's going to be different for each fund. So if you think that there are those material gains or losses, to work out that better outcome, you will need to do a calculation under both methods. Accurium, as with all the other certificate providers, we are happy to do a certificate for you based on one of those methods, and then you can apply for an amendment free of charge to get the outcome under the other method as well, so you can work out that difference. Now we only have a few minutes left, so I am just going to, for the most part, skip the next couple of slides and we'll go through to questions. Very quickly, the next couple of slides are just about failing the minimum pension requirements, which of course is the main thing. We can talk about strategies for claiming exempt income and try to maximize that exemption as much as we want. But if you don't pay your minimums, then, well, you're not eligible to claim exempt income. So that is probably the first thing you want to make sure that you do each year is make those minimums, or you've got that planned and they will be made. And of course, if you don't, yes, you can always apply to the ATO, and depending on the situation, you may be allowed to claim exempt income for that year. But certainly if you come to Accurium at least, and I assume again the same with any other provider, showing that you haven't made any pension payments, we will not complete a certificate under the assumption that you have met those standards. We would need to see confirmation from the ATO first that the fund will be allowed to claim exempt income for that year. So as I said, we'll skip those last couple, and we will now go on to the questions. I think we've had just a few come through during the year.
Yeah.
During the presentation.
Thanks so much, Matthew. We did have a few questions come through, and we do have time to go through those. So let me have a look. We do have one from Judith. Hi, you said that pension must be a series of payments. If the pension amount is always drawn as a single amount in June each year, will that qualify?
Yes. And I think there's a second question as well, which essentially covers that same sort of thing. But yes, so a pension requires a series of payments. That can be a single payment each year. So yes, it's totally fine to just make a single payment in June. Or it can be multiple payments in the same year. Either is fine and does work as a series of payments. Again, as I said, of course, if you're making a single payment each year, just be careful of the pension starting in the year, making a single payment, then it's stopping in that year. But yes, if it's running for multiple years, you're only taking a single pension payment each year, that is totally fine. That still classifies as a series of payments and meets those requirements.
We've also got one from Mark. We are in full pension mode and have been for several years. My wife and I take one pension payment each year. I have looked at ATO re-pension payments for SMSF, and they say you can take one pension payment for the year. Your comment?
Yeah. So that was that second question there. So
yeah.
So yes, same answer. Yes, that's fine. Taking only that single payment each year.
Yeah. To segregate shares, would it be good to have one parcel HIN registered and one SRN registered? Both registrations in the super fund name, but this would allow dividends for each parcel to be streamed to separate bank accounts.
As I said, there's no requirement to do that. You can just have the single registered parcel and then say that yes, 1,000 of these shares are segregated, 1,000 aren't, and when the income comes in, you can then, when dividends come into a bank account, if you do have two separate bank accounts, you could just transfer the amount to the other bank account. That would be fine. So that can still totally work. It's up, as long as you can show on your side that you can show that, yes, these are the segregated shares, these are unsegregated, and then you can, once the dividends come in, you can correctly show what's the segregated dividends and what's unsegregated, and you can move that to a different bank account if you have two separate ones, or if you have the same bank account, you can show that what is the segregated part of that bank account. That's fine. But yes, it may be clearer if you are intending to segregate to do that as two separate parcels, but it's not required. It can just be the single one as long as you can show on your side, this is what's segregated, this is the segregated income. this is what's not segregated, this is the unsegregated income.
We have, what is the impact of making a withdrawal and recontribution on the same day and immediately converted to pension?
Okay, yep. So I will assume that that's in relation to how the calculation for the exemption would work. So looking at that scenario, if the fund, let's say the fund one was solely pension for the year, and then this was the only accumulation money, where they've made a lump sum, recontributed on the same day, and then converted that straight back to pension, then in that case, you would still be fully exempt. You would still be 100% exempt for that year. It does raise the question about whether the fund could have disregarded small fund assets, because as we talked about that test, it's based on, you check the members, check their prior 30 June balances, if they have more than 1.6 million, if they have a pension. And then specifically though, the part of that test is saying, was the fund solely retirement phase for the year? And if the fund is solely retirement phase for the year, it won't have disregarded small fund assets. But in this case, you've done a withdrawal, recontributed, and then converted back to pension on the same day. So even though we would say the fund is still 100% exempt, technically, we would say the fund is not solely pensioned for the full year. Technically, it does have an accumulation balance for a period of time in that year. So we'd say this fund could technically have disregarded small fund assets and need an actuarial certificate, even though it would be fully exempt. The point of view of the fund, which is solely pension for the year, it does raise the possibility of maybe needing an actuarial certificate, even though it would still be shown as being fully exempt. For a fund which was already a mix of pension and accumulation and would claim exempt income using the proportionate method, essentially doesn't really have much of an impact. If it's all happening on the same day, it's the same amount that's being withdrawn, recontributed, converted back to pension. From an ECPI point of view, from a calculation point of view, it doesn't change anything. The start and end of the day is still the same amount in total that's in pension. Though, of course, you'd need to consider pension payments for that new pension account.
Great. We do have a few more questions, but that's probably all we have time for. So first, I want to say thank you, Matthew. That was an amazing presentation. Accurium is a silver sponsor at this year's RegTech event, and they will have a stand at Brisbane, Sydney, Hobart, and Melbourne. So if you haven't already got your tickets, they are free. You can scan the QR code on the screen now and go and visit the team to find out some more, get your questions answered. As I mentioned at the beginning of the session, the recording of the webinar will be available to you as well as the slides. So you'll receive these. Don't worry if you did miss out on a bit of the webinar today. But that does bring us to a close. So I do want to thank everybody online for joining us. I want to say a big, big thank you to Matthew from Accurium for joining me today. You did a fantastic job, and we look forward to seeing you next month at RegTech.
Great. Thank you, Lily. And everyone, hope you have a good day, and I may see you again. And so for any Accurium clients, if you have any questions, you can give me a call. For anyone else, your actuary should be able to answer these questions as well. So if you do have any questions, certainly you can give them a call or send an email as well.